It is time to talk about your money right here on Good Morning Quad Cities. And first, let's take a look at how the stock market is doing at the end of last week's trading. The S&P 500 down 4.5%, NASDAQ down 5%, Dow Jones Industrial Average also down 4%. All right, we've been talking about the U.S. Federal Reserve currently in the midst of the most aggressive pace of interest rate hikes in nearly half a century. Its goal is to try and get inflation under control. So joining us is our financial expert, Mark Grabocheski. He's from the Quad Cities Investment Group. Good to have you this morning.
Good morning to you, Ann, and a very happy Monday to you.
Very happy to see you. I think it was Wednesday when we saw you when the Feds were meeting and they were talking about this interest rate hike. So it's been a few days now that the news has settled in. The interest rate going up nearly 1%.
Yeah. Well, following last Wednesday's announcement, Federal Reserve Chairman Jerome Powell, kind of gave some further insight as to why the Federal Reserve, needs to be so aggressive in raising interest rates. And he said that they continue to see more and more evidence that inflation is going to remain historically high for quite some time, most likely, and for most, if not all of 2023, but also potentially into the early phases of 2024. And the longer this high inflation lasts, the greater the risk the economy, potentially goes into some type of severe recession. So to get this high inflation under control as soon as possible, and that's the key phrase, as soon as possible. The Fed argues it needs to be very aggressive in raising interest rates. Now, from early 2020 up until February 22, so almost a 2-year time span here, the Federal Reserve kept the Fed funds rate near 0%. But look at this, Ann. Over the last 6 months, the Fed fund rate has been driven higher, again, from near 0% up to 3.25%. By the end of the year, maybe the first month or so in 2023, they're expected to drive it even higher to 4.25%. The end result, as you just pointed out, the most aggressive pace by the U.S. Federal Reserve in nearly half a century.
In his statement, though, he said this will impact American families.
Well, it did. More specifically, to inflict some level of pain on American families. Now, look, historically, when the Federal Reserve raises interest rates, it likes to do so at a very gradual, methodical pace. For example, Ann, they'd like to raise the Fed funds rate by just 0.25%. Maybe a couple of months later, again, raise it by 0.25%, and so forth. And that allows consumers and businesses, families, the economies, to better absorb the impact of those rising interest rates. But the risk of having so many interest rate hikes, again, in such a short, compressed window of time, is that it does inflict some level of pain on the U.S. economy. But the Federal Reserve, Ann, argues that, yes, all these interest rate hikes do cause some level of short-term pain to the economy. But if we don't start to aggressively address this high inflation, the longer-term economic pain will be much, much greater.
What about our seniors or people that are on fixed incomes? How is this affecting them?
On the positive side, we are starting to see interest rates start to rise a little bit for, savings accounts, certificates of deposits, and even bonds. And seniors and fixed income persons do tend to rely on those type of investments to help supplement their income. Now, but look, 12 months ago, Ann, investors were really struggling to get a rate of return of just 0.25%. Now many CDs, many bonds are offering a rate of return of 3.5%, 4%. The challenge, however, though, Ann, is inflation, as we know it, is at 8.3%. So even though many of those types of fixed income investments that seniors and fixed income people rely on are starting to go higher, it's still less than half the rate of inflation.
All right, Mark, thank you for your expertise this morning. We appreciate seeing you.
Good to see you again.
Have a great week. All right, stay with us. We're back right after this.